Iran just closed the Strait of Hormuz, and with it, 20 million barrels a day vanished from the global markets. We went from oversupply to a projected billion barrel shortfall almost overnight. This isn't a price spike, this is a structural shock. And for Canadian investors, it changes the map. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're tracking three stories that connect in ways that aren't obvious at first glance: a global oil crisis, a contrarian bet on American equities, and Canada's quietly worsening manufacturing problem. Rory Johnston breaks down the Hormuz closure, fund manager Brian Belsky makes a bullish case most people aren't ready to hear, and IceCap Asset Management explains why Canada keeps falling behind on competitiveness. Let's get into it. Rory Johnston, one of the sharper oil analysts in the country, laid out the math on the Loonie Hour this week, and it's sobering. The Strait of Hormuz closure cut 20 million barrels per day from global supply. That's roughly 20% of the entire global market gone. With 13 million barrels per day of upstream production offline, Johnston estimates we're stacking up a cumulative billion barrel loss over just 5 weeks. Markets move fast. Brent crude is now trading at $95 for June delivery versus $75 for 2027 contracts. That's a $20 premium for oil you can get your hands on today, which is the opposite of how futures markets normally work. When buyers are paying a steep premium for immediate barrels, that tells you the shortage is real and the anxiety is real. Now, who blinks first? Johnston gives a 40% probability to what he calls the unilateral tango, Trump withdrawing from the standoff due to market pressure. His reasoning in the US-Israel-Iran triangle: Trump is the only actor genuinely sensitive to external economic forces. Markets punish him directly. The other two aren't operating on that same feedback loop. Worth noting, though, a 40% base case is not a high conviction call. It means Johnston sees a 60% chance this doesn't resolve cleanly. Escalation remains very much on the table, and oil markets hate uncertainty more than they hate high prices. For Canada, here's the upside nobody's talking about. Asian nations are now actively interested in investing in Canadian pipeline infrastructure. If Middle East supply can't be counted on, Canada's landlocked oil suddenly becomes a lot more attractive, provided we can get it to tide water. That's a big if, but it's a real one. So that's the supply shock. Now, how should investors be positioned in a market this rattled? Brian Belsky has a surprisingly bullish answer. Fund manager Brian Belsky appeared on the David Lin Report with a contrarian take that's either very brave or very right, maybe both. He's calling for the S&P 500 to reach 7,300 to 7,500 through 2026. His core argument isn't about fundamentals, it's about sentiment. Bearish sentiment is sitting at 51.4% against a historical average of around 31%, and it's been above that threshold for 8 consecutive weeks. Belsky's read: when pessimism runs this deep for this long, the historical pattern is a significant market recovery over the following 24 months. Fear itself becomes a contrarian signal. His positioning reflects that he's overweight communication services such as Google, Netflix, Spotify, along with financials which he thinks benefit from deregulation and consolidation, and finally utilities. He's neutral on tech broadly and underweight the Magnificent Seven, which is a meaningful divergence from most institutional positioning right now. One of his more interesting observations is about who is underperforming and why. Belsky argues international clients got hurt in 2024 and 25 because they mark to market daily and trade tactically. They kept missing the recovery days. Wealth clients, thinking in years instead of weeks, did better. He also sees a coming rotation from private equity into small and mid-cap public companies as investors trade illiquid private deals for liquid public markets. Here's the counterpoint worth sitting with. Bearish sentiment lasting 8 weeks is notable, but it's not unprecedented. And in some macro environments, prolonged pessimism is warranted, not just emotional. With a genuine oil supply crisis, tariff uncertainty, and slowing growth, the bears may not be irrational. Belsky's thesis works beautifully if the macro holds. It's shakier if the Hormuz disruption deepens or spreads. Belsky is betting on recovery, but back home, IceCap Asset Management is asking whether Canada is even positioned to participate in one. Richard Diaz at IceCap Asset Management has been tracking something that's been quietly deteriorating for years: Canada's manufacturing sector. The numbers are blunt. Manufacturing has been in recession since May 2023 and now sits at just 8.3% of GDP, a record low. Meanwhile, the US has grown manufacturing output 24% since 2013. Canada has preferential access to 1.5 billion consumers through trade agreements. The market access is there, the output isn't. But here's where the easy narrative breaks down. Look at this chart. Canada was already slipping before Trump's first term. The gap opened around 2015. COVID hit both countries hard. The US bounced back, Canada didn't. That's not a tariff story, that's a structural one. Capital investment confirms it. Canadian manufacturers have been pulling back consistently since around 2015, through multiple governments, through Trump's first term and then through Biden's. When businesses stop investing in their own capacity, they're telling you something. IceCap blames regulatory burden primarily. Canada now ranks near the bottom of global competitiveness tables. The January carbon tax hike of 16% compounds that at exactly the moment the US and China are holding their costs flat. IceCap calls it economic self-harm. Hard to argue with the timing. Yes, Trump's 2025 tariffs hurt, you can see it in the latest data, but blaming him for this is nearsighted. These charts show a decade-long problem that predates him entirely, and framing it simply as Trump's fault lets a lot of domestic policy decisions off the hook. And finally, this one might be the most damning. Canadian manufacturing workers are producing less per hour than they were a decade ago. American workers keep getting more productive. That gap compounds quietly, and it's very hard to reverse. The uncomfortable conclusion: this isn't one government's fault, it's regulatory drag, carbon costs, underinvestment, and tariff shock, all stacking on each other over time, and that actually makes it much harder to fix. Pull back and look at what these three stories have in common. They're all about where capital flows next. Johnston sees the potential end of what he calls the Carter Doctrine, the decades-old guarantee of free-flowing Middle East oil. If that guarantee is no longer reliable, supply chains get rerouted and Canadian energy infrastructure becomes a serious destination for Asian investment capital. That's a long-term structural opportunity if Canada moves on it. Belsky argues that the investors who win the next decade are the ones who resist the reflex to trade tactically through every single headline and stay positioned in sectors with durable tailwinds, such as financials, utilities, and communication services. And IceCap is issuing a warning. Canada's competitive position is eroding in manufacturing at the exact moment global supply chains are being forced to diversify away from Asia. That should be Canada's moment, but only if the policy environment makes it viable. The thread connecting all three? Disruption creates opportunity, but only for the prepared. Well, that's your daily read for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.